Datadog reported first quarter 2023 earnings this morning, and the stock is up 14% after the results. Is the move justified, or is the stock moving too much too quickly? I'm going to answer that question in this video, reviewing Datadog's latest earnings results. So let's begin. Revenue increased by 33% for Datadog to 482 million. This is really good results for a company that's experiencing headwinds as enterprises are trying to pull back spending wherever they can, and one of the areas where they can pull back spending is on observability solutions that Datadog offers. That caused the company had a turnaround here. They reported a loss per share of 8 cents, which was a turnaround from an earnings per share of 3 cents in the same quarter last year. Total operating expenses jumped from 278 million to 417 million. In addition to rising cost of goods sold, the company spent more on research and development and sales and marketing to boost its effort to offer solutions to customers. Speaking of customers, for the company, customers that spend over 100,000 per year with Datadog increased to 2,910 customers. That was up from 2,250 customers in the same time the year before. So solid customer growth here. One of the main reasons why I believe the stock was up 14% year over year is Datadog is attracting big value clients even in a difficult macroeconomic environment. Like I mentioned earlier, enterprises are looking to cut back spending wherever they can, and the fact that Datadog was able to secure this many new customers and boost the top line by 33% impressed investors. The company is generating positive cash flow, although cash flow from operations decreased to 134 million. This was down from 147 million in the same time last year. So even though the company was not profitable on the bottom line, Datadog still delivered positive cash flow from operations. The biggest difference between its profits and its cash flow was stock-based compensation, which is a non-cash expense. So when a company pays its employees in stock-based compensation like options and grants, they need to account for that on the income statement as an expense, but it's a non-cash expense because money doesn't go out of the company when they grant those stock options. The forecast for the rest of the year looks solid. Q2 revenue of 500 million would be a slight incremental increase from the 482 million this quarter. And then for the full year, they're forecasting revenue of 2.1 billion, which if the company does hit that target, that would be an increase from 1.675 billion in revenue it reported in its previous fiscal year. So again, solid growth in a difficult macroeconomic environment was better than the slowdown that investors were fearing and caused Datadog stock price to jump 14% after these results. Keep in mind, however, this year is still going to be a significant slowdown for Datadog. If you look at the last, let's say, 4 years of revenue growth for Datadog, in 2019 it grew revenue by 83%. In 2020 it was 66%. In 2021 it was 70%. 2022 62.8%, and the forecast for 2023 is only a modest growth of less than 30%. So a significant deceleration in revenue growth is expected for Datadog, although that could arguably already be priced into the stock, which is why you saw the stock price pop after these earnings were announced. So I would say no, the market is not overreacting to the news of Datadog's quarter. It was better than feared. The company did a good job adding new customers, generating positive cash flow from operations, and giving an outlook for the rest of the year with solid growth, even though it's slower than the year before. All right, so that's all I've got for this video. Thank you so much for watching. I hope I'll see you soon. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.